Is this the worst deal ever? MGM Resorts just sold its best assets to the Blackstone Group, to Wall Street. And the short answer is yes, this is the worst deal that has ever happened, especially if you are a resident of Las Vegas or an employee of MGM Resorts. Welcome to Jaron Lukas Live, a show on YouTube that has actually been proven to make you smarter while you watch it. The science is in, it's undeniable proof. This show will make you smarter. And our topic today is going to cover what is such a bad deal. I can't even believe that it was announced. So let's get right into it. And we're going to start by going straight in to the source of truth, Investors Business Daily, which I've been covering quite a lot on this show recently. And their article is titled MGM Strikes $2.5 billion deal to sell these iconic Sin City resorts. Iconic is right. And they forgot to say that this is the worst deal to ever happen. Not on Wall Street. This is actually one of the best deals to happen for a Wall Street firm. And it's actually part of a class, as we're going to talk about here, of transactions that are happening. This is the latest scam that investment banks have come up with. And mind you, I used to be an investment banker, by the way, for 4 years. So, and I was also in private equity, which was on the other side of this deal. So this is something I know about. We're going to go into great detail. Whether you're an evil investment banker who's watching this show, like I used to be, and you're trying to figure out what kind of deals you should be working on right now, or you are a shareholder. By the way, this is not stock advice. So everything I'm talking about today is really coming more from a moral standpoint. And we're also going to be looking at why this is so bad for the residents of Las Vegas and all the employees of this gigantic company. So, and this channel, for those of you who are new to it, is really covering topics about how do we make the world better? What have the boomers been doing wrong that is messing things up? And that's this deal is really a prime example of how these things can go wrong. So going right into it, MGM Resorts International is selling the MGM Grand Las Vegas and Mandalay Bay resorts for $2.5 billion as the casino giant continues to shed real estate assets. The properties are being sold to a newly formed joint venture between MGM Growth Properties and real estate behemoth Blackstone Group. The latter firm will own 49.9% of the joint venture, which means that they're making this a 50-50 transaction, which is, by the way, we're going to go into this one too. This is not the first time that MGM has done this either. They recently sold the Bellagio, effectively selling the Bellagio, all of its real estate, which I can't really think of what would be a more important part of the casino than its real estate. But yeah, here they are selling originally the Bellagio. They also had a transaction where they sold Circus, and now here we are. They're selling the MGM Grand, which carries their name, and the Mandalay Bay. So what they have done is for $2.4 billion in cash and about $85 million worth of this new real estate company's stock, they have sold all of their real estate for these properties and now have a lease payment that they have to make, a rather large one. And the question begs, why are they doing this transaction? Maybe to some people, having more cash in the company seems like a good idea, especially as there are many recession fears that are growing. And that's certainly true. The question is what are they going to do with the cash? And I suspect that this cash will be used in a way, which I'm going to explain. It will be used in a way that benefits the very near-term shareholders who, as you can see, the stock has just jumped. And this is coming at the expense of the long-term shareholders the companies, Las Vegas, and all the employees of this company who are ultimately going to be affected when an economic downturn happens. So this maneuver that seems to be in preparation for that, which it actually might not be, because as we'll go further into these articles, they talk about, this is Fox 5 News, our one of our hometown news resources, and what it talks about is how they want to do more of these transactions. And going back to the IBD article to begin with, they want to focus on sports betting, entertainment, and casino development projects. So what they've done here is, one, they've added more debt off the balance sheet to their company. They have more expenses, and they're going to take the cash that they just produced and they're going to invest it instead of saving it for a rainy day. So when you add all these things up, what happens? First, things look rosy. You have more cash on the balance sheet. Seems like maybe an okay deal. But when an economic recession happens, a few bad things are going to happen here. First, just like in the last recession, and mind you, either this recession or the next one is going to be worse. In the last one, tourism completely dried up. So we have that. We have tourism at some point is going to slow down or dry up completely, which means that revenues are going to be hit. Expenses are going to have to be dealt with, meaning people are going to get laid off. But the revenue is going to go down so much more than the expenses that they can kind of cut down on, that they're going to have to start digging into this cash reserve. The problem with this transaction is that they just signed an agreement where they now have to pay a lease payment. So they've just increased their expenses during a recession. They're going to invest a lot of this cash into things that are highly speculative. And going 2-3 years after a recession takes place, first off, worst case scenario is that they can't make a lease payment. And if MGM can't make a lease payment, that means that the company is straight up screwed. But what's going to happen here is that Blackstone is going to do a deal where they get to they forgive a little bit of the lease payment, but they take a lot of equity. And so this is really an effort on Blackstone's part to take more equity through these land lease deals. And it's not the first one that's happening. This, again, is Wall Street's latest concoction that will see them owning more assets across America. And mind you, where do they get this money? Wall Street receives all of its money from the central bank. So you have the central bank, the people at the top here who can actually access that kind of money, which are the banks. And bankers do deals with their friends. Their friends here being Jim Murren, the CEO of MGM, who might be a great guy. I don't know. All I know is that he makes bad deals. And so what is happening here is that the near-term shareholders and Blackstone Group are benefiting heavily from this deal. Whereas if you look 10 or 20 years ahead, the shareholders of MGM are worse off, because what they've done is they've taken their safest asset, they've given it away, and now that sliver at the top, which is their operating cash flows, that's going to get collapsed during a recession. A lot of people are going to get hard hit in that next cycle. A lot of people are going to have to sell, and these are normal people. These are really the people who are worst off, right? Because the people who still have a lot of cash aren't going to have to sell their stock at that time. It's the people who maybe they've levered themselves too much in every area of their life and they have to sell stock to make their mortgage payment. Those are the people that are going to get hit when this happens. Those are only the first people to get hit, because there's also a longer lasting effect here where the longer term shareholders of this stock this agreement sees to it that they have a less percentage ownership of their future upside if and when a recession happens. So this kind of deal really hits me hard if you can't tell already. Because again, this is not a stock advice video. This is looking at the inner deals and inner workings that are happening in corporate America that are fueled by the people at the very top who have access to loans and leverage, debt, and this huge amount of capital. Like, you could be an amazing tech entrepreneur. Most of us can't access $2.5 billion. Mind you, it's a goal of mine. And it actually probably won't be worth that much by the time I can do it. It'll probably be worth like 200 million because of all the inflation that we're going to have over my lifetime and your lifetime too. If you're a millennial or Gen X and you're actually learning about this with me, this directly impacts us. And it's a shame because it really is reflective of the boomer generation and the way that they are just trashing on not only our environment, but the longevity of major corporations and jobs. And so that's why this hits me really hard and why I'm covering it in an episode today, which, by the way, if you're watching the live stream, thanks for tuning in. And this is a live stream, so you can chat with me if you have any questions or opinions of your own. If you're catching this in a replay, make sure you subscribe and click the like button. Well, I was actually going to say click the notification button so you get notified of future live streams, but also hit that like button because if you agree with what I'm saying here, that'll make sure that YouTube's algorithm shares this with more people so we can spread the message and get more people informed on what's happening here. I know that this is a very high level topic, and I'm not describing it in necessarily the simplest of ways either. But I think it's important, given that like I have studied economics very intensely. I also worked on these kinds of deals right after college for 4 years. And I've been behind the scenes on what's happening and how these conversations happen. And so the problem here is that the trend is getting worse. What has happened is usually a company's cap table is divided up in two primary ways. The first is equity. If you take any sort of startup company, high growth company, which apparently MGM is now becoming, there's only equity. There is no debt. Debt is risky. Now, if you are a company that makes billions in cash flow, okay, maybe you add a little debt, but it's this third tranche. This third tranche of invisible debt that's not on the balance sheet, but is debt. It's actually accounted for as it too. I'm not just making that up. If you look at the added debt that this adds to the company and what's going to happen when the revenues dry up, I mean, it's very clear what MGM thinks is going to happen, which is they feel that a recession is going to come. Actions speak louder than words, people. Friends, really. You are my friends. And so as we move forward, and by the way, Wall Street has also sold them on this idea. Wall Street is clearly at this moment telling large corporations who are their clients that a recession, the likelihood of a recession is rising, and you should prepare, Mr. CEO friend, because if we hit a recession, you remember what happened last time, you better have cash for this next one. And this is all part of a cycle that Wall Street has, right? When you're entering a recession, they start to sell you on getting cash onto your balance sheet. Then they take a % of those transactions. And then after the recession hits, then they advise the people with cash to buy companies, and they take another percentage of that. I technically don't have a problem with that one. Like if you're helping buy and sell companies, but I am just explaining like the general flow here of how there's always something to sell. And so you're at the bottom. The acquirers, the people with cash, have just bought a lot of companies that are going bankrupt for very cheap. And then as we exit the recession, they sell them more debt and more IPOs, and then they go off and grow. So it's these general cycles, and the part of the cycle that we're clearly at is you need cash. A recession is about to happen. You need cash. And it comes at the expense of the people who work for the company who are about to get laid off. It comes at the expense of the city of Las Vegas. I actually tweeted today to most of the city commissioners, county commissioners, about what they think about this. I haven't checked if there's a reply because I've been working on my own companies all day. But I would love to know, city commissioners, what do you think of this? Because jobs are going to go away very soon. And one of our major companies just sold all of its real estate assets. It literally sold its portion of Las Vegas. Imagine if a Chinese company came in and acquired all of that. How would we feel then? So that maybe not a different country, but it's a different city, and it's not going to be good. So if you feel me, let me know in the comments. This video has really been about explaining the inner workings of how these transactions work. If you want to dive deeper in for yourself, I recommend actually starting to look at MGM Resorts balance sheets. And this is part of the reason why this transaction is so odd to me, is because if you look at their most recent balance sheet, they still have $1.2 billion of cash. So it makes me wonder if there might be a self-serving purpose for these transactions to happen. It's kind of hard to say that, oh, we need the cash to weather a storm. Like, they have the cash. So why are you complicating your balance sheet at the expense of employees, the city, and your shareholders? That's my question. If you found this topic interesting, hit the like button and I'll do more videos like this. Thank you so much for joining. And don't forget that this is a live show. I've moved my whole channel into live stream this year. So make sure you subscribe and click the notification bell so that you'll be notified when I do these. And most importantly, stay visionary.